Stop. Listen. Right now, the market is telling a story so strange, most people are missing the plot entirely. Gold is breaking records, silver is moving like it's been shocked awake, and at the very same moment, the artificial intelligence boom is accelerating, pouring billions into the stock market. This isn't supposed to happen. Not all at once. Conventional wisdom says when fear runs to gold, greed flees from tech. But conventional wisdom is broken. What we are seeing is not a contradiction. It is a symptom of a deep, hidden imbalance in the very foundation of the global financial system. This is not a story about picking the right stock. This is a story about understanding a fracture between the paper world of promises and the physical world of things, a fracture between what is reported and what is real. To understand why gold, silver, and AI stocks are all screaming higher, you must first understand the quiet panic happening in the vaults, the boardrooms, and the mind of every investor who is starting to realize the numbers no longer add up. Let's begin with the official story, the one you see on the news. Gold is hitting all-time highs. The headlines will tell you it's about inflation, or interest rate cuts, or geopolitical uncertainty. And those are factors, but they are not the cause. They are the kindling. The spark is something else entirely. To see it, you must look at an official action, a slow-moving shift that has been unfolding for years in plain sight. Central banks around the world have been buying gold, not as a trade, not as a speculative bet, but as a strategic move. Based on their own published reports, central banks added over 1,000 tons of gold to their reserves last year. That is not a small adjustment. That is a statement. Why? Because gold is unique. It is not someone else's liability. A bond is a promise to pay. A currency is a promise of value. A bank deposit is a promise to return your money. Gold makes no promises. It is just there. In a world where financial systems are increasingly used as tools of policy, where sanctions can freeze assets, where currencies can be manipulated, where debt levels call into question the value of future promises, the appeal of an asset with no counterparty risk becomes profound. It becomes boring. And in finance, boring is often the most valuable thing of all. This isn't about the death of the dollar. The dollar's role as the world's primary trading and reserve currency is built on a network of deep, liquid markets and decades of trust. That infrastructure does not vanish overnight, but dominance is not the same as stability. A king can remain on the throne even as his kingdom erodes. The steady, relentless accumulation of gold by the world's most conservative financial institutions, the central banks, is a signal that the erosion is being acknowledged at the highest levels. It is a rebalancing of the global savings account. They are not betting on a catastrophe. They are insulating against a slow decay of trust. This is the official action. It is calm, methodical, and massive in scale. It provides a constant, underlying bid for physical gold that has nothing to do with daily news or trader sentiment. It is the deep ocean current beneath the surface waves, and it has changed the fundamental landscape of the gold market. Now, to understand the pressure this creates, you must see the disconnect. The split between two parallel worlds, the paper market and the physical market. In the paper market, gold and silver are traded as financial contracts. Futures, options, ETFs. You can buy and sell these contracts with a click. You never see, touch, or own a bar of metal. This market is vast, highly leveraged, and dictates the price you see on your screen. It is a market of promises to deliver metal, not always the metal itself. Then there is the physical market, the actual bars, the coins, the silver going into solar panels and electronics. This market is about real inventory, real shipping, real vault space. For a long time, these two markets moved in relative harmony. The paper price was an accurate reflection of the physical reality. But harmony requires balance. And balance requires that the paper promises can, if demanded, be settled with the physical thing. What happens when that assumption is questioned? This is where the data becomes critical. In the silver market, for instance, the industrial demand from sectors like AI infrastructure, electrification, and green energy is not a maybe. It is a certainty. It is a constant sucking pull on actual physical silver. Yet the mining supply for silver is largely fixed. It takes years to bring a new mine online. So you have a physical market that is structurally tight, with demand that is essentially mandatory. Meanwhile, in the paper market, traders can take enormous short positions, betting the price will go down, by selling contracts they do not physically possess, relying on the ability to buy them back later before delivery is required. This works flawlessly, as long as the physical metal is readily available to backstop those paper promises. But if the physical metal becomes scarce, the mechanism seizes. The paper market and the physical market begin to pull apart. The price on the screen may lag, but the reality in the vault becomes the ultimate arbiter. This disconnect is not theory. It is visible in the data. Reported inventory levels in the registered vaults of major exchanges like the COMEX, the metal that is readily available to settle those paper contracts, have at times trended downward even as open interest, the number of outstanding paper contracts, remains high. The ratio of paper promises to physical deliverable metal becomes a point of tension. It is a silent tug of war. The official price is set in the paper market, but the final authority is the physical one. When entities start taking large-scale delivery of physical metal, withdrawing it from the exchange vaults entirely, they are not making a speculative bet. They are making a logistical decision. They want the thing, not the promise of the thing. This action quietly tightens the noose. It reduces the available buffer for the paper market. It is a slow, deliberate withdrawal of trust from the paper settlement system. This is the contrast that matters. The soaring prices we see are not just a speculative frenzy in the paper world. They are in part a gravitational pull from the physical world, where the shelves are getting bare and the buyers are no longer content with IOUs. So, what is on those shelves? Let's talk about the vault, the inventory, the supply side data. This is the forensic part of the story, the numbers that are reported but rarely assembled into a coherent picture. Major commodity exchanges operate a system of vaults. They hold metal in two main categories, registered and eligible. Registered metal is the working inventory. It is the metal that has been assayed, approved, and is sitting there ready to be delivered against a futures contract to settle a promise. Eligible metal is also in the vault, but it is resting. It is often held for other purposes, like an ETF or a bank's own balance sheet. It can be moved into the registered category, but that requires the owner's consent and a process. The number that flashes on traders' screens is primarily influenced by the flow of metal in and out of the registered category. This is the immediate supply. Now watch this number over a long period. Do not look at the day-to-day noise. Look at the trend. For silver, the trend of registered COMEX inventories has, over multi-year periods, shown a pattern of decline. There are periods of replenishment, but the general direction has been down. At the same time, the total open interest, the total number of paper promises outstanding, can remain elevated. The ratio of paper claims to each available deliverable bar tells a story of leverage, a story of a system operating with a thinner and thinner cushion. This is not necessarily a crisis. It is a condition of tightness. It means that any sudden surge in demand for actual delivery, not for paper contracts, but for the metal itself, meets a system with less slack. It means the friction between the paper price and the physical price can increase. In the background, the demand from industry never stops. A data center being built needs silver in its electrical contacts. A new factory needs it in switches. This metal is consumed. It does not come back to the vault, it is gone. So the vault sees a one-way drain from two sides, the steady pull of industrial consumption and the episodic, large withdrawals of investors or nations who want to hold it outside the system. This supply-side data is dry, complex, and often ignored, but it is the bedrock. The price can dance on this bedrock for a long time, but eventually the foundation speaks. The recent surges in price are the market's mechanism to attempt to rectify this imbalance. A higher price should, in theory, encourage more supply from mines or recycling and discourage some demand. But mines cannot turn on a dime, and some demand, like that for AI and power infrastructure, is not optional. It is part of a trillion-dollar build-out that is already underway. The vault data, therefore, is not just a record of stockpiles. It is a gauge of pressure building in a closed system. Why would the institutions that help run this system allow such a pressure to build? What is their motive? It is crucial here to be neutral and factual. Banks and large financial institutions play multiple roles in this market. They are market makers, facilitating trades for clients. They provide liquidity. They trade for their own accounts. Their primary motive, in a neutral sense, is to generate revenue and manage risk. The futures and derivatives markets are a source of significant revenue through fees, spreads, and trading profits. A volatile, active market is often a more profitable environment for these activities than a stagnant one. Furthermore, the ability to sell contracts short, to bet on a price decline, is a fundamental part of providing liquidity and hedging other exposures. It is not by itself a nefarious act. It is a function of the market. However, this practice relies on a core assumption that physical metal will always be available to close out positions if needed, or that the counterparty will accept a cash settlement instead of demanding metal. As long as the vast majority of contracts are closed for cash or rolled forward into new contracts, the physical scarcity is a background concern, not an immediate one. The institution's motive is to keep the machine running smoothly. A smooth machine is a profitable one. Acknowledging a severe physical shortage publicly could disrupt that machine, triggering a scramble that would be immensely costly for any entity caught on the wrong side of the trade. Therefore, the incentive structure is to manage the day-to-day, to use the paper market to balance flows, and to assume that any physical tightness will eventually be resolved by higher prices bringing new supply or by a reduction in demand. It is a motive of operational continuity. It is not a conspiracy to suppress price, but a structural preference for the stability of the paper-dominated system they operate and profit from. The risk they face, which is a professional, cold-eyed risk, is that the physical market stops playing by the paper market's rules, that a large enough actor or a collective shift in behavior decides to consistently demand delivery, draining the registered vaults to a critical level. At that point, the paper price and the physical price would be forced to converge, and the convergence would be violent and unpredictable. For the institutions, this is a tail risk to be managed. For the physical holder, it is a potential outcome to be aware of. The motives are not aligned, but they are understandable within their own contexts. Amidst this institutional calculus, where does the retail investor stand? This is the human element, the psychology. Put yourself in that position. You see the price of silver soaring. You read about AI and green energy. You hear whispers about shortages. The feeling is a mix of excitement and deep anxiety. The fear of missing out, the FOMO, is powerful. It whispers that if you don't act now, you will watch from the sidelines as life-changing wealth is made by others. This feeling is amplified by social media, by charts going parabolic, by stories of huge gains. It is a genuine emotional pressure, but it clashes with another deeper fear, the fear of being wrong, of buying at the very top just before a crash, of being the one left holding the bag. This internal conflict leads to a tortured psychology. You might buy a small position, then watch it rise. The regret of not buying more is acute, so you buy more, but now your average cost is higher. Then a pullback comes, a normal, healthy market correction, but to you it feels like confirmation of your worst fears. The paper losses scream at you. The emotional pain triggers a survival instinct. Sell to stop the pain. Very often, this sell order comes at the very moment the pullback ends. You sell at a loss, the price recovers, and you are left with the twin demons of regret and shame. This cycle is not a failure of intelligence. It is a failure of psychology. The market's volatility is a tool that systematically exploits every human emotional flaw: greed, fear, impatience, and pride. The retail investor, watching the epic clash of paper and physical markets, of institutional motives and central bank strategies, is often simply trying not to be washed away. The empathetic truth is this: it is incredibly difficult to hold an asset through violent swings when your financial future feels tied to every tick. The key is not to outsmart the institutions, but to outlast your own emotions. This means understanding what you own and why. If you are buying a paper contract of silver, you are making a short-term bet on a price movement. You are a guest in the institution's casino. If you are buying physical silver, you are making a long-term bet on a physical imbalance, accepting the hassles of storage and illiquidity. These are two entirely different endeavors with two different psychological profiles. Confusing them is the source of most pain. The market does not care about your hopes or your fears. It is a mirror reflecting back the collective actions of all participants, amplified by their insecurities. To navigate it, you must first understand what you see in the mirror. So, where does this lead? Let's explore a scenario-based conclusion with no advice, simply a narrative of possibilities. Scenario 1. The rebalancing continues. Central banks keep buying gold steadily. The industrial demand for silver continues its relentless climb, slowly but persistently drawing down visible inventories. The paper markets remain dominant but become increasingly nervous, leading to higher volatility, sharp rallies followed by sharp pullbacks, but with a gradually rising floor over years. The AI boom fuels corporate profits and stock market gains, but also fuels the commodity demand that supports metals. In this world, all three can trend upward together. Not in a straight line, but in a chaotic, stressful, overall upward grind. It is a world of both growth and fear, of innovation and hedging. Scenario 2. The fracture widens. A geopolitical event, a banking stress, or simply a critical mass of delivery notices triggers a liquidity crisis in the paper precious metals markets. The price discovery mechanism breaks down for a period. The paper price and the physical price diverge wildly, with physical metal commanding a large premium for immediate delivery. This would be a seismic event for finance, causing massive losses for some paper shorts and windfalls for some physical holders, but also creating a crisis of confidence in the entire futures market structure. It would likely lead to extreme regulatory intervention and a painful reformation of the market. In this scenario, the connection between AI stocks and metals might temporarily snap, as a general financial panic causes a sell-off in all risk assets, including tech, with only physical assets holding their value amidst the chaos. Scenario 3, the pressure relieves. A global recession hits, slowing industrial demand for silver. New mining supply, incentivized by years of high prices, finally comes online in a flood. Central banks pause or reverse their gold buying. The AI investment cycle hits a temporary slowdown. In this world, the physical tightness eases dramatically. The paper market regains full control, and prices retreat to a lower equilibrium. The narrative flips from scarcity to abundance. The recent surge is remembered as a speculative bubble that popped. These are just 3 paths in a forest of possibilities. The future is not predetermined. It will be shaped by the invisible hand of the market, the visible hand of policy, and the unpredictable chaos of world events. The only certainty is that the tension exists between paper and physical, between promise and reality, between the digital future AI is building and the tangible ancient metals that underpin it. This tension is the engine of the story you are watching unfold on your screen. It is the reason gold, silver, and AI are all surging, not in spite of each other, but because of a deeper, hidden imbalance they are all, in their own way, responding to. The market is sending a message. It is not a simple one. It is a complex, layered signal about trust, scarcity, innovation, and the eternal human struggle between belief in the future and the desire for something real to hold on to.